Assalamu alaikum friends, welcome to SBR revision series for September 2021, and today we are going to cover a very small standard IAS 20. How do we account for government grants? So government grants recognition. Government grants can only be recognized when you have the assurance, when you have the reasonable assurance that you're going to receive the grant, and also you have complied with the conditions. These two things has to be there. Otherwise you cannot recognize the grant. Okay, and grant are two types. One is income grant, the other one is capital grant. And the way you deal with each of these two are different. If it's an income grant, okay, so income grant given to subsidize expenditure, that means to reduce your expense, should be matched to the related cost. It should be matched to that cost, the grant which is given to you. But most of the time in your exam, the second type of grant is given, which is capital grant, which is known as capital grant. This grant is given for the purchase of non-current asset. Okay, and how do you recognize this? This should be recognized over the expected useful life of the related asset. That means, let's say the useful life of the asset is 5 years. So if you are receiving the grant, you have to recognize the grant over 5 years, divide by 5 the value of the grant. Okay, now there are two acceptable accounting policies for recognizing this capital grant. Number one, you deduct the amount of the grant from the cost of the asset and then depreciate the net cost. Okay, or treat the grant as a deferred income. You don't deduct, you treat the amount of that grant as a deferred income and recognize it in the statement of profit and loss. Present under statement of profit and loss over the life of the asset. That means if it's the useful life of the asset is 5 years and the grant is 10 million, 10 divided by 5, 2 million. So every year under statement of profit and loss, you'll be showing 2 million as deferred income. Or if you are planning to deduct it from the cost of asset, let's say the cost of asset is 10 million. Okay, grant is 5 million and useful life is 5 years. So 10 minus 5, 10 non-current asset, 5 grant, 10 minus 5, 5. Now you divide that 5 by 5 years, which is 1 million. Okay, so most of the time this question is asked as a discussion question rather than calculation part, but they might ask as a calculation part to show you how it should be accounted for. Then you should be able to apply these two accounting policies, right? Deduct it from the cost of the asset or show as a deferred income. So make sure that you know. And if it's an income grant, it's simple. Just you need to match with the related costs. So that's it for government grant. And next we'll be covering IAS 21, which is the effect of changes in foreign exchange. Okay. And this I will be talking about the group accounts and all, foreign subsidiaries and all, how to translate and then consolidate. Remember, whenever foreign subsidiaries are there, when you're acquiring them, when you're consolidating them, before you consolidate, you have to translate them into the same currency as the parent and then consolidate. So all those issues we will be covering in IAS 21. Till then, thanks for watching and see you in the next video.